All right, let's dive into the mind of a legend. Today, we're unpacking the early philosophy of Warren Buffett, one of the most successful investors ever. We're going to find out how he used something incredibly rare, patience, to build an absolute empire. You know, in a world that's all about high-speed trading and instant gratification, where fortunes can be made or lost in a split second, how did one man get ridiculously wealthy by sitting still? He wasn't chasing the hot new thing. He was reading, thinking, and then, for the most part, doing nothing for decades. So what's the deal? Was it just dumb luck? Or did he tap into a secret that the rest of the market is just too impatient to see?
And that right there, that's the key to his entire universe. For Buffett, risk isn't about a volatile market or a scary-looking chart. No. Real risk is just not doing your homework. It's investing in something you don't truly understand. This one idea is the foundation for everything that follows.
To really get Buffett, you have to understand his mentor, Benjamin Graham. This is the man who literally wrote the book on investing and gave Buffett the entire framework for how he sees the world.
From the very beginning, Buffett was just wired differently. While other kids were collecting baseball cards, he was collecting stocks that were priced wrong. His very first trade at age 11 taught him a brutal lesson when he sold too early and missed out on a huge gain. By the time he was a teenager, he was tearing through financial reports like they were action novels. But the real game changer? That was when he walked into Benjamin Graham's class at Columbia University.
Graham gave Buffett a name and a system for what he was already trying to do: value investing. The idea is so simple, it's beautiful. Your job is to figure out what a business is actually worth, its real underlying value. Then, you just sit back and wait for the crazy, emotional market to offer to you at a steep discount. It's literally the art of buying a dollar for 50 cents. And this quote, man, this explains the whole game. Price and value are two totally different things. The market, day to day, is just a popularity contest. But over the long haul, it's a scale. And eventually it weighs the true value of a business. Buffett realized his job wasn't to guess the popular vote, but to accurately weigh the company.
But here's what makes Buffett, well, Buffett. He didn't just copy his teacher's notes. He took Graham's ideas and evolved them. He realized that buying super cheap, junky companies wasn't the only way. There was a much more powerful strategy: buying quality.
So early in his career, he was doing what he called cigar butt investing. Picture finding a discarded, soggy cigar on the street that has one last free puff left in it. Kinda gross, right? But hey, it's a free puff. That was his strategy with stocks. It worked, but it was a lot of work for small gains. With the nudge from his partner Charlie Munger, his thinking flipped. Why buy a fair company at a wonderful price when you could buy a wonderful company at a fair price? So his definition of value got a major upgrade. He started looking for businesses with powerful, consistent earnings. He wanted a business model that was built to last, run by people you could actually trust. And, most importantly, he looked for what he called an economic moat. Some kind of durable, competitive advantage that protects the business from invaders, just like a moat protects a castle. His investment in Geico is the perfect example of this new thinking in action. He saw an absolutely brilliant business. By selling insurance directly to people, Geico cut out the agents and had this massive cost advantage. This wasn't just a cheap stock. It was a superior money-making machine protected by a deep, wide moat. He pretty much bet the farm on it.
Okay, so armed with this powerful new philosophy, Buffett started managing money for other people. But he wasn't going to do it like some typical Wall Street hotshot. He built the whole thing on a concept that was basically alien at the time: total, absolute trust.
Just look at these rules. They're incredible. He took zero management fees, he only made money if his partners first made a solid 6% return, and here's the kicker: he put his own money right alongside theirs and promised to take the first hit on any losses. He wasn't their manager, he was their partner, plain and simple. Their goals were perfectly 100% aligned.
So, how did this all work out in the real world? Well, let's look at one of his classic early plays, the Sanborn Map Company. To everyone on Wall Street, this was a dinosaur, a boring, obsolete map business nobody cared about. But Buffett wasn't interested in the maps. He was interested in the math. And what he found was just mind-blowing. The company was sitting on a huge portfolio of other stocks, and that portfolio alone was worth $65 a share. You with me? But the stock itself was trading for only $45. The market was basically offering him a dollar for less than 70 cents and throwing in the entire map business for free. It was a no-brainer. His playbook was so simple, it's almost genius.
First, read the reports and find the treasure nobody else sees. Second, start quietly buying up shares until you have a say. And third, use that influence to convince management to unlock that hidden value for everybody. This isn't speculation, it's just profiting from the market being lazy.
So, when you strip away all the numbers, the strategies, and the stories, you get to the single biggest lesson of all. And you know what? It has almost nothing to do with being a genius. It's about something else entirely.
This is it. Buffett is absolutely convinced that your temperament, not your IQ, is what will determine your success. You can have a brain the size of a planet, but if you panic when everyone else is panicking, you're toast. The real superpower is staying rational when the world around you is going crazy with fear or greed.
And if you want the ultimate proof, look at what he did in 1969. The market was in a wild speculative frenzy. His partnership was crushing it. And what did he do? He did the unthinkable. He shut it down. He gave all the money back to his partners because he couldn't find a single thing to buy that made sense. He chose to walk away from the game rather than play in a casino.
And that all leads to these core principles that have been his North Star for decades. First, stay in your lane. Never invest in something you don't get. Second, realize that sometimes the most profitable move is to do absolutely nothing. Third, integrity is everything. And finally, always remember, you are buying a piece of a business, not just a ticker symbol that wiggles on a screen.
So that leaves us with a pretty challenging question, doesn't it? In our world of constant alerts, breaking news, and nonstop pressure to act now, could it be that the most strategic, most intelligent, and most profitable decision you can make is to just take a breath, sit back, and have the discipline to do nothing at all?